and welcome to today's webinar, The Future of Stablecoins, co-hosted by the Chamber of Digital Commerce and Armanino. I'm Perry Ann Boring, the founder and president of the Chamber of Digital Commerce. We are the world's leading trade association in the blockchain industry, representing over 200 companies across the ecosystem. Our mission is to promote the acceptance and use of digital assets and to fight for a predictable legal environment for businesses innovating with blockchain technologies. Today, we are joined by some of the industry's top thinkers and operators of stablecoin networks, from the Digital Dollar Project, Circle, Trust Token, and Paxos. Each of our speakers will be interviewed for about 20 minutes, and we invite all of you to join us in the discussion by submitting your questions in the Q&A function through the Zoom webinar feature at the bottom of your screen. Next, I'd like to introduce our co-host, Noah Buxton of Armanino.
Thank you, Perry Ann. Thank you all for joining us, and thank you to the Digital Chamber for making this possible. Some of you have no doubt made it here through sort of the Hashing It Out series, and so we consider this also a special edition of Hashing It Out. We appreciate you following Armanino's Hashing It Out, and we're looking forward to another exciting and thought-provoking discussion today. And in the spirit of Hashing It Out, it's really all about community conversation and participation. There is a huge group I've seen flood in. We can't take video questions today given the size of the group. However, we do invite you to use the Q&A feature. So please bring your questions and we'll try and pick them up as we go. I think your questions might be the most relevant here today. So with that, I'm your host, Noah Buxton. I am a reformed attorney with a background in risk assurance and IT. And sorry to all the attorneys to say I'm reformed, but I do love what I do every day. I'm lucky enough to put my experience and my passion to work really in a very hands-on way. So I get to lead our blockchain practice here at Armanino. I get to act as a subject matter expert for our digital asset clients, and I get to product manage and build the new assurance technology solutions that we're building for this space. For those that don't know the Armanino name, briefly let me tell you, we are a top 25 public accounting firm. We're the largest headquartered in California, and we service clients nationally and internationally with about 1,300 Armanino folks. We also have a specialized industry practice. We've been serving leading names in the crypto and blockchain space since 2014. And as I said, we build new solutions for this space. So we have an innovative focus, and one of our goals every day is to fill gaps that we see in the space. So for those of you on the call that I haven't met yet, I look forward to the chance to connect. My team and I have been working in stablecoins since about mid-2018, and I have to say I'm extremely energized by the growth that I've seen in this space in the past 2 years, and even, wow, just the past few months. For those of you on the call that are following this closely, you know that the past couple months have been very interesting for this space. I wouldn't say stablecoins are quite yet a household name, but I think the stats do speak for themselves. You know, over the past 2 years, we've essentially seen a 10x growth in stablecoin market cap, and the daily trade volumes or daily volumes of stablecoin activity are really impressive. You know, they've gone from pretty low numbers to about 20 billion today on an average day, and they've actually doubled. The market cap has doubled in the last 3 months. So the upward trend is clear. I think the real question is, wow, where does this take us? And so that's why we have the great thinkers and stablecoin operators here joining us today. And I really want to get into the future. So the last thing I want to say before introducing our first guest is maybe just a quick stablecoin 101. I want to give our thought leaders here the chance to dive right into the meaty topics without having to explain stablecoin 101. So for those of you who have joined us where this concept is a little bit new, what is a stablecoin? They are tokens issued on public blockchains. Their overarching purpose is to provide all the benefits of crypto without the volatility, therefore being a more suitable store of value, an already accepted unit of account, and theoretically, and I think what we're seeing is in a more improved medium of exchange. There are essentially 3 types. You've really got fiat-backed or fiat collateralized stablecoins. You have crypto collateralized stablecoins, which are backed up by other cryptocurrencies. and you have algorithmic seigniorage shares type coins, which really aren't backed by anything other than an algorithm that maintains their stability peg. So there's many different approaches to this. The companies and the thought leaders that we're talking to today essentially operate fiat collateralized stablecoins. And what that means is that their tokens, while virtual, are redeemable for real world dollars. So with that quick stablecoin 101, I'll invite Dan Gorfine. So Dan is founder of Gattaca Horizons, a boutique advisory firm, has a long track record in think tank, public policy, strategic communications, and was former chief innovation officer, the first chief innovation officer at Lab CFTC. So also serving as an adjunct professor at Georgetown University of Law, teaching fintech law and policy, and most importantly for today, the co-founder of the Digital Dollar project. So let's jump in. Welcome, Dan.
Great. No, it's great to be on. And I should add, Noah, I think I'm a reformed or at least a redirected attorney as well. So I want to start with that.
That's great. Great minds think alike. So Dan, we mentioned that you are co-founder of the Digital Dollar project. Tell us, what is the Digital Dollar project?
Yeah, no, it's good. So, great to join all of you. The Digital Dollar project is a not-for-profit effort that we launched earlier this year. I did that in partnership with former CFTC chairman, Chris Giancarlo, his brother, Charlie Giancarlo, who's an executive at a tech firm out in the Bay Area. And then David Treat, who's a managing director at Accenture, is one of our partners in the Digital Dollar project. We can go into a little bit more of the background of the DDP, but at its core, it's a not-for-profit effort focused on exploring tokenization of the US dollar at the government or federal reserve level. So essentially trying to understand and advocate for the potential benefits of tokenization of the US dollar. So as you mentioned, we launched earlier this year, and just a few weeks ago put out a white paper that goes into a little bit more detail of what a so-called champion model would be for a tokenized US dollar.
And so what was sort of the impetus? When did these conversations start among the co-founders and sort of the people in your network? What was the real impetus for starting this project?
So you mentioned I was previously at the CFTC, where I was the director of Lab CFTC, their financial technology and innovation office. And over the years have spent a lot of time meeting with and learning about various types of crypto, blockchain, tokenization type firms and concepts. And I think one of the things that stood out to me, which will be no surprise to anybody on this joining this meeting, is that you can send information via an email halfway around the world with very few intermediaries at very low cost. And what I think tokenization, blockchain, crypto, a lot of what this represents is the idea that you can send information about value and unique ownership of value halfway around the world with relatively little friction, fewer intermediaries, and at lower cost. And that's pretty profound. I mean, that's going to eventually impact, I think, the way we transact all types of financial assets and instruments, including money and including fiat money. So Chris Giancarlo, as many of you have heard from previously, very like-minded and certainly has been one talking about the need for the United States in particular to upgrade some of our financial infrastructure. So having left the CFTC, Chris and I are good friends and stayed in touch and talked about these types of issues. And last fall, one of the observations we had is that there didn't seem to yet be kind of a national policy around exploration of how tokenization could impact the US dollar itself. So Chris and I published an op-ed in the Wall Street Journal last fall, and you can consider that a bit of a call to action. We got a lot of really incredible inbound and people interested in the topic, wanting to know what we were going to do next. This included some of the folks from the Accenture team. I mentioned David Treat, who are also very like-minded. And so one of the things we thought we needed to do after issuing the call to action was think about how can you actually catalyze action? How do you bring together all of the necessary stakeholders and perspectives to have the conversation about what it would mean and what the implications are of tokenizing the US dollar, how that ripples through a national economy, the global economy. And so that's a difficult topic to work through, but we thought we might be able to create the right platform for doing that. So that's what drove the launch of the Digital Dollar project early this year. And as I said, the white paper outlines at least our current thinking on the topic, and also outlines kind of a set of expectations of what would be next, which would largely be pilots, real world trials, so that we can measure the purported benefits of tokenization, as well as some of the challenges in actually implementing that.
So Dan, what you're talking about, I think, is what we call in the industry a centralized, a central bank digital currency, or CBDC. Is that essentially what the Digital Dollar project is aiming at?
Yeah, so it is focused exactly right on central bank digital currency, CBDC. I mean, it might make sense for me to just outline a few key attributes, because again, this is a very broad topic. And when you say CBDC, there's a lot of mixed perceptions and ideas out there as to what that would mean in terms of design. Of course, there are a lot of design choices. There are a lot of trade-offs with certain costs or characteristics. But when we talk about CBDC from a digital dollar project perspective, we have a champion model, one that we would like to test against other, designs and other types of payment mechanisms. So the first and I think really important element here is that when we say CBDC, we're talking about actual tokenization of the dollar, as opposed to an account-based system. There have been some congressional proposals, around Fed accounts, the idea that the Fed could go directly to retail. They may do that through kind of the current account reconciliation process. That's not what we're suggesting as the champion model. Instead, we're suggesting actual tokenized central bank liabilities. So the same way you can hold physical cash, which is backed by the full faith and credit and issued by the government, this would be a tokenized dollar with the exact same kind of attributes. The other key characteristic is that we believe this should be issued through the existing two-tiered banking system, meaning that existing banks and other types of regulated money transmitters, so that would include all of those from the world of fintech, and the types of licensing and regulation that they are subject to, would be the kind of primary distributor. So it would not be direct central bank to retail, which we don't think would be a wise design choice. Instead, largely through the existing two-tiered structure. We can get into this a little bit more as well. I mean, our champion model presumes that the actual rails would be DLT or blockchain based. Of course, there's a lot of really thorny questions about how you operationalize that, who serves as validators, but we think that there are privacy and resiliency benefits from that type of structure. And the last thing I would point out, especially relevant to the discussion today, our champion model is not in any way antithetical to private sector innovation and a lot of the developments around stablecoins and other crypto assets. In fact, to be totally blunt, we wouldn't be having this conversation today, but for Bitcoin. I think that Bitcoin is the reason that people started thinking about, systems, friction, automation, interoperability of networks, and all of the things that are kind of driving the back end of how money moves. So we view a lot of the private sector innovation to be incredibly relevant and actually to help inform what would be a public sector driven initiative like a tokenized CBDC.
Yeah, that makes a lot of sense. You made 3 points there that I want to dig into a little bit more. First, I want to sort of just ask you how far you are along in this project, and maybe also note for the audience that Digital Dollar Project has published a white paper. I think it's worth reading. There's obviously significant thought that has gone into it.
You better say that.
Go ahead and check it out. Google it and download it if you haven't already. But Dan, I mean, when you think of the horizon here of where you guys are going, how far in are you? Are you just in ideation stage?
It's a great question. Look, it's a massively complicated subject. And, one thing during the crisis, there was a lot of concern about how funds were being distributed, and people started thinking about, well, could a CBDC be helpful? And that it's the right set of questions to be asking, but this is not something that you can implement overnight. I mean, we're talking about the US dollar. It is the reserve currency, or at least the current choice global reserve currency. And there's a lot that you need to make sure you do right. So our view is that it is absolutely the right time to be exploring and pursuing a CBDC, but it needs to be done really thoughtfully. And so as a result of that, where we are in the project is that we've published, as you said, the white paper. It is quite detailed, at least in our current thinking. Now, there are a lot of questions and a lot of open questions. Solving for the balance between proper law enforcement needs and privacy is a critical one. Talking about the rails and the governance of the payment system is a critical one. Understanding whether the purported benefits are there in different types of applications like retail, or domestic payments usage, wholesale, international applications. All of these things need to actually be tested out. So in terms of what this likely looks like, we wanted to kind of have this round of discussion around the white paper. From there, what we would suggest is that there be real world pilots and trials so that you actually can measure. I mean, we can talk a lot about this, but until you start testing this in the wild, it's very difficult to really measure the outcomes. Obviously, there are some global central banks that are probably a bit further along in that real world piloting or testing phase. So we think that that's really, really important. But look, realistically,
are you working with any of those? Sorry to interrupt. Are you working with any of those players? Are you getting feedback on those experiments?
Well, I'll say that one of the real benefits of partnering with Accenture is that blockchain team is working with a lot of the global central bank projects. So there's a good wealth of expertise there. We also have had the opportunity to speak with many of the other central banks that are working on these projects to learn from them, hear from them. I also think keeping that line of communication is critical because interoperability is going to be a critical piece of an ultimate design. You certainly don't want to start creating like these siloed CBDC projects that don't really make sense for a global economy, especially US dollar leadership in a global economy. So all of that is really important. Look, the time is right now to do this. In our original op-ed, Chris and I referred to this as kind of the space race, or the desire to put a man on the moon from many decades ago. And it took over 10 years for that to happen. In the process, it spawned incredible technological innovation and development to get to that endpoint. And there's a lot of design and thinking design choices and thinking that goes into a successful project like that. And we view this as very similar. It's going to require kind of obviously public sector leadership. At the end of the day, we cannot tokenize the US dollar. I mean, that will be the Federal Reserve in conjunction probably with other regulators in Congress that would have to make that decision. But the private sector, the way we do things in the US typically is through kind of strong private sector leadership. And that's the same kind of model we think we should be applying here.
And now it's stupid question time. So what problem does this really solve? If you had to just boil it down to one or 2 points, what's the real pain point or the real problem that this solves?
This goes back to, I think it's not a rocket science observation, but it's the view that if you were to design systems today to move value and information about value and ownership, would you use the same systems that we designed 30 years ago? And the answer is no, because they're going to be legacy systems, often siloed, with many intermediaries and manual processes that are not the most efficient. So if you start with the idea that computers connect and we should be able to move information about value in a very efficient way with fewer intermediaries, then the potential ripple through of the entire global economy of that profound point, I think is substantial. So where does it help? Again, I would boil it down to like 3 broad categories. There's the retail component of this. May this impact individuals seeking to make purchases with a different payment option? Maybe merchants and vendors who want to receive a competitive source of payment. Perhaps there's maybe an access and inclusion aspect here, where if the technology and operational costs are lower of this system, and digital wallet service providers are able, from a tech, operational, and regulatory perspective, offer a lower cost service than, say, traditional bank accounts, you should have kind of more ubiquitous access to that type of a wallet service. So perhaps we can pull certain percentages of or underbanked populations in. That's just the retail side. You've got wholesale payments in markets, and the idea that you would have far more efficient financial transactions if you were able to do this with tokenized money. So there's tremendous benefit there. And then, of course, at the end of the day, I mean, this is central bank backed money. It is the most risk-free fiat currency in the world. So there you could see a lot of kind of international use as well. Then you've got the international kind of remittance aspect of it, which is also a promising channel. And look, at the end of the day, this is again the idea that when it's very hard to predict exactly how this flows through a very dynamic global economy. So I assume there are going to be many benefits that we're not even contemplating right now. I know we haven't gone into like the programmability aspect of money, but I think that's another really important aspect.
We've only just scratched the surface. And
yeah, We have a couple questions that have come through the Q&A. Dan, to focus on some of the regulatory aspects and the policy aspects of this.
Sure.
You mentioned that the Digital Dollar Project cannot be the entity that tokenizes the US dollar. The government ultimately has to do this. There seems to have been a bit of a shift in the tone from Fed, Treasury, Congress on the topic of a digital dollar since we've entered into this global health pandemic and economic crisis. Can you just talk about how conversations have changed over the past several months regarding the digital dollar and the different government entities that you guys are engaging with?
Yeah, I mean, the tone has shifted, as exactly right. And I think, look, I think that the crisis underscored areas of weakness in a lot of digital infrastructure. I think digital identity is actually a really big piece of this as well. But leaving that aside, I do think that a lot of things have changed. I'm even going to go back to before the pandemic. I mean, you obviously have developments like the Libra project. You've had more announcements coming out about the digital yuan project. That was at the latter half of last year, that there was even more attention focused there. All of these developments, I think have gained kind of broader attention from traditional banking sectors, from policymakers, and from Washington in particular. I think the tone of what you've heard has shifted over time as a result of that. I think there are a lot of really good efforts happening in the US. I mean, whether it's organizations like yours, Perry Ann, certainly our hope of catalyzing further action through the Digital Dollar Project, and a lot of academic efforts. You've seen global papers coming out from Bank of England, BIS, IMF. I mean, a lot of thinking going on, and I do think that's gotten people's attention. So what I think is promising is that regardless of the political spectrum, I think a lot of people in Washington see potential benefit through a lot of different lenses. I mean, you can talk about access inclusion, you can talk about the economic role of the US dollar globally. All of these things resonate. So there has been a shift. You know, I do think government moves slowly, and the Fed is going to be very cautious, and rightfully so. I think what we'd like to see is safe spaces created so that testing and piloting is possible. So I think that that's what I'd hope to see come out of this period. And I would assume that policymakers will increasingly say, even if you're a skeptic, why wouldn't you? Isn't it prudent? Isn't it practical to plan for the possibility that there are real benefits here? And if you're going to do that, you can't just flip a switch 5 years from now and start issuing a tokenized US dollar. There's a lot of back work that would have to happen. So now is that time.
Yeah, we've got time for about one more question, just to shift gears here on a topic I know a lot of chamber members, we've had a lot of conversations at the chamber on, but you guys have some very interesting approaches to the privacy design around central bank digital currency. How are you guys approaching privacy from the aspect of a digital dollar?
So privacy is one of those like key categories that's like its own specific work stream. You know, look, I would say how we're approaching it is with a clear understanding that privacy is one of the things that could give a US dollar, a tokenized US dollar, a certain competitive advantage relative to perhaps other global designs. And privacy is important, and expectations around privacy are very important. So we take that very seriously. At the same time, there are going to be appropriate regulatory and law enforcement needs where you do need to satisfy, you know, the existing BSA AML regime. How you balance that, I think the best starting point is to hold the analogy with physical cash. I mean, clearly our system recognizes distinctions between smaller size transactions versus larger size transactions. And I think that's a good starting point. There have been a lot of central banks that have thought about it in that same way. So I you know, that's an area where I think design, it's a policy choice at the end of the day, but starting to think about whether smaller transactions may err on the privacy side of the spectrum seems to make good sense. And it's probably most consistent with how people would expect, you know, a US CBDC to be designed.
Dan, I realize we're going to need about 4 hours for our next session. So thanks for committing to that. We appreciate it. And
no, I appreciate it. I'm looking forward to hearing the next presentations. And, you know, if I can leave with one final point, you know, the more I've been thinking about the tokenized US dollars, you can think about it almost like a public highway, right? Like the interstate system was created. It impacted certain types of transport businesses, but also created new transport businesses and unleashed a lot of economic activity. I think it's the same thing with tokenized CBDC. I think that the amount of private sector innovation and development that can be built on top of that wrapping further programmability around a tokenized dollar is really exciting. So I think that that's kind of a segue into some of the next conversations, but that's an area where I think a lot of creativity can be applied.
Thanks so much, Dan. Really appreciate your time today.
Awesome. Thanks all. Take care.
All right, our next speaker really needs no introduction at all, but I'll introduce him anyways. This is Jeremy Allaire. He is the co-founder, chairman, and CEO of Circle, and one of the early pioneers in the digital currency space. Circle was founded in 2013, and they have pioneered the fiat currency-backed stablecoin USD coin, or USDC. USDC is issued by regulated financial institutions. It is backed fully by reserved assets, and it's redeemable on a one-to-one basis for US dollars. USDC is governed by Center, which is a membership-based consortium that sets the technical, policy, and financial standards for stablecoins. And they just announced today a collaboration with the Algorand Foundation. Jeremy, thanks for joining us today. Noah, back over to you.
Thank you.
Thanks. Yep. Thanks, Perry Ann. Thanks, Jeremy, for joining us.
Absolutely.
So yeah, Jeremy, I think I wanted to jump right in and kind of help the audience understand the lay of the land when it comes to sort of the use cases. So who are the holders and who's transacting right now in stablecoins, and what are the major use cases you see?
Yeah, I think it's important to step back a little bit from it, which is if you actually read the Center white paper, there was one in 2017, and then when we launched in 2018, an updated white paper. Clearly what we're envisioning is a standard set of protocols for fiat value exchange on the internet, and not specific to just dollars, but to leading reserve currencies, and creating protocols in the same way that we have protocols like HTTP for moving data and content. We have protocols like VoIP for doing things like we're doing right now. And these standards exist, and they allow for interoperability and global reach, and that's really powerful. So we clearly saw the need for setting those standards in an open way, in a governed way. And the use cases are designed ultimately to be as broad as the use cases of money. And so what would you do with a dollar that is digital? And ultimately that is going to be every form of transaction, whether it be a person-to-person transaction, a merchant transaction, a B2B transaction, a financial transaction, a securities transaction, any number of applications that would benefit from a digital dollar and the ability to use that on the internet are use cases. And so that's sort of broader vision. Now, when USDC launched in late 2018, we thought of it as sort of, there's a bootstrap use case, which is sort of who's going to need that today. And back in late 2018, it's really driven by basically people who understood the benefits of cryptocurrency and who needed digital dollars, which were traders. And so a lot of the early phases of stablecoins and these digital currency, these fiat digital currencies were originally created as almost like capital markets infrastructure, so market infrastructure that allowed both individuals and institutions to move value across venues, exchanges, et cetera. Now, that's really started to shift. And so starting in 2019, corresponding to the growth of smart contract development, you saw things like USDC increasingly used in combination with smart contract applications such as decentralized finance, credit markets. So for example, if you want to borrow or lend, you can access a decentralized credit market. You can supply USDC as collateral. You can borrow in USDC. That's grown pretty dramatically. That's now hundreds of millions of dollars of transactional activity and issued USDC that is in those kind of savings, lending, payments use cases. And then finally, really most notably, over the last, I'd call it roughly 6 months, but it's accelerating. We're seeing more and more businesses that are realizing that this is just a superior form of payment and settlement when you combine, a full reserve digital asset that is liquid and redeemable with the superpowers of digital, meaning you can transfer it at the speed of the internet, with final settlement, with very high levels of security and privacy, with virtually no fees, and that can work with anyone, anywhere in the world. That's really powerful. And so businesses are starting to adopt it for international transactions, B2B transactions, and things like that.
Yeah, very interesting. So that goes to some of the future use cases. I like your explanation of, at that higher level, it being really any use of money. What do you think what's the future use case that you're most excited about? Where do you see this, thinking about this, the future of stable coins, you know, whether it's 3-5 years or longer? What's the most the use case that you're most excited about?
Sure. I mean, I think you know, when we got started in this problem space, in the digital currency space, in 2013, I think you know, my background's not in the financial sector. My background's really in building internet platforms, in software platforms, content platforms, media platforms. And I think it's been interesting to watch over the past you know, 20 to 30 years as these open networks and protocols make it possible to do things that in the past cost money or had time delays or were kind of in closed loop ecosystems, and really moving to an open internet model really dramatically changed what became possible and radically changed the unit economics of those things. Whether it's, we now have instant free global communications, we now have access to all the world's knowledge instantly at no cost. These are really powerful benefits of these open networks. And so I think from our perspective, when I think about 3 to 5 years out, I think that these standards and these kinds of stable coins, you know, in many respects, will just make moving value a commodity-free service on the internet. And we'll look back in the same way that we look back at long-distance telephone calls, or the way we look back at snail mail, or the way we look back at how information was published in catalogs and proprietary databases. And we'll look back at money transmission, and we'll say, I can't believe that people actually paid something to collect or make a payment. It'll just be a commodity-free service on the internet. And so I think we're on a path towards that, and that will increase the volume of transactions in the world. It will allow billions of people to participate more freely in those types of transactions. And then the really exciting thing is when you combine these digital currency assets with the programmability that comes with these public networks as well. And we've just never had a world where, you know, what I like to call money is a native data type on the internet. When money becomes a native data type on the internet, people, developers, engineers, creative problem solvers can innovate around it and do really exciting things. And so blockchains are interesting because they provide this, you know, sort of permissionless, secure, global, interoperable transaction settlement medium. But they're also interesting, and in particular, sort of second generation blockchains and now third generation blockchains, is because they're also distributed computing engines. They provide a tamper-proof, nation state attack resistant surface area for executing code and contracts. And so what I'm interested in is, how do we start thinking about economic contracts differently globally? How does a laborer in you know, another part of the world, in India or in Venezuela or in you know, Korea, contract with another service that's somewhere else in the world and move value and intermediate that through code that is enforced by machines? And so smart contract-based economic contracting that builds on this basically commodity-free service of moving value, I think is where the really interesting things start to happen.
Yeah, I tend to agree with you. The programmability of money it has incredible potential. That's even hard to measure today.
Yeah, I mean, I use the analogy of, you know, that there's a lot of times you have these convergences of technologies and you don't see what's possible. You know, for example, you know, the iPhone came out and, you know, the first version didn't have an app store and it was on the slow internet networks. And then, you know, they'd introduce a new version, it had 3G. So it was a little bit faster and it had an app store so people could create things for it. And it also had a GPS built in, and people thought, oh, GPS, that's neat, I'm gonna be able to get directions. But what people didn't realize is when you combined those three things together, you could revolutionize logistics and transportation industries and build platforms like Uber and have just tremendous value creation and open up entirely new labor markets and change things. I think the same thing today about public blockchains, stablecoins, and smart contracts. The synthesis of those, when you start to innovate with them, we don't know what people are going to create. I mean, Compound is a really fascinating example. It's a recent one that's sort of exploding, which is people determined you could create a credit market that doesn't have an intermediary. That was inconceivable just a few years ago. And so what are people going to be able to create with this? We don't know, but I think it is going to be very significant.
Are fiat collateralized stablecoins, are they the end state or are they an intermediary step towards sort of this digital future that we're talking about, programmable money? Is it the end state or an intermediate step?
Yeah, I'm very much of the view that I'm what I'd like to call an internet maximalist. There's Bitcoin maximalist. There's various maximalists. I'm an internet maximalist, and what that means is I believe that a greater and greater amount of how society and the economy and organizations themselves function is going to be operated, natively on the internet. And I include things like courts and law and other stuff. I think will ultimately move to those realms. And I think because of that, we're going to be entering a period where, in particular, when you think about digital currency, a digital RMB that is a liability of the Central Bank of China that exists on the internet. It exists everywhere at once. It exists intergalactically. It just exists wherever the internet exists. And so money has the reach of the internet instantly. The internet doesn't care about borders. And any person or business or country that wants to transact with China will be able to do that directly over the internet. And that's really profound. It's profound for every global economy. But I think what that ultimately is going to lead to is, effectively, we will see the rise of the sort of most actively used currencies in trade and settlement operating as digital currencies. And ultimately, we'll see synthetic global currencies that emerge from this. And so I think we're on a path, an inevitable path towards synthetic global currencies that are built out of the most important trade currencies of the world. And I think we'll operate in a model like that. And I ultimately believe that those global synthetic digital currencies will also have components that are made up of not just sovereign assets, but non-sovereign assets such as Bitcoin as well. And so in the past, we had fiat backed by gold, and then you had ratios and the like. I can imagine a world in the future where you have digital gold in ratios to fiat reserve currencies in a basket that creates a new synthetic global currency.
I was kind of thinking about the past too there for a second with you. And I just drew this analogy in my mind. It's almost like the free banking era in a way, maybe some similarities, right?
Yeah, I mean, the innovation on the internet is really profound, and to quote Mark Andreessen, sort of software eats the world. Now software is eating the financial system and the global economic system, and the internet is converging with that, and it's really exciting. And there's a lot to embrace. And I would say, compared to earlier eras of fintech, this is quite profoundly different because there are just so many creative entrepreneurs, developers, software engineers that are interested in sort of rebuilding the way that the international monetary system works. This is no longer just the provenance of central bankers. This is no longer just the provenance of large banks. Like, this is sort of being developed with very broad open source communities around the world. And that's how the internet's been built. It's been built that way for 30 years, this sort of collective effort to build up this infrastructure. It's not a top-down effort. It's very much a bottom-up effort.
When you think about maybe your business or maybe just sort of this stablecoin industry in general, what do you think are the biggest impediments to making this more mainstream, more widely adopted? Like you said, used by enterprises, used in retail transactions.
Yeah, I mean, I think there's a few things. I think there are technology barriers for sure, but I think we're very, very close to resolving some of the most important ones. So some of those have to do with sort of how do you create a user experience at the end user level, which is really straightforward. Like, back in the early days of the internet, like, you had to know things like how to type in like protocols and all this stuff into web browsers, and using email was a lot more complicated. And then you had services and browsers and search engines and other things that abstracted that. And I think we're very close to that in this digital currency world. We're, I think, literally, months or quarters away from really seeing some breakthroughs on the user experience side of things. The other sort of technical impediment is, we're very much in need of third generation blockchain infrastructure, in particular public blockchain infrastructure, because we want to build systems that are resilient and interoperable globally. And the only way to do that is on the public internet. So third generation public blockchain infrastructures that can support hundreds of millions and then through other techniques, even billions of users. I think we're also very close to seeing that infrastructure coming to the market. And that's very exciting. But I think the other piece is
when you say third gen, sorry, just for our users to break that down really quickly. When you say third gen blockchains, what are you referring to?
Yeah, so effectively, you had the sort of first generation, which were sort of single purpose blockchains, like for just a single token, like Bitcoin. You had second generation blockchains that introduced concepts like smart contracts and the ability to execute code on these blockchains, but also the ability to issue other tokens and assets. But they had very significant scalability limitations. And then third generation are really trying to address the scalability limitations of the second generation blockchains. And they're also, I think, building in underlying kind of primitives or building blocks that are really, I think, useful to, say, global financial applications. And so those third generation chains, I would include Ethereum 2 as a third generation blockchain. I would include the Libra network blockchain as a third generation blockchain. Platforms like Algorand, which we just announced we're bringing stablecoins to with something powered by USDC as well. And there are others that are emerging, are really key to that, And those are like operating systems, and they just get faster and better, or like the addition of broadband to the internet. They just try to increase the capacity. The third piece, though, is regulatory clarity. And so I think one of the most important work streams happening right now is the Financial Stability Board's work stream around establishing G20-wide regulatory frameworks for global stablecoins. And so the key thing is that the biggest financial regulators in the world all agree that global stablecoins are here. They're arriving, they're going to grow. And that's quite distinct from central bank digital currency projects. We're talking about private sector-led initiatives like Center Consortium, Libra Association, and other private sector actors. These are here, and they're growing, and they're going to get bigger and bigger. And there has to be rules of the road. Financial institutions, corporations, and then ultimately individuals that depend on those corporations and financial institutions are going to want to know that this operates with rules of the road. And I think the policy recommendations that are coming out, and which will ultimately come into effect through legislative initiatives around the world in 2021, are going to be really key to really opening this up for billions of people.
Yeah, the regulatory side of things is certainly important. And just so you're aware, and so other folks are too, the Chamber is preparing comments to the Financial Stability Board. I'll be sharing information at the end of the call on that. But Jeremy, we'd love for you to be a part of those conversations as we're putting together our thoughts and our policy positions to the FSB and the Bank for International Settlements. We're getting a number of questions for you. I'll try to get a few of these in before we're up for time. Sure. There was a big announcement, or not really announcement, but PayPal has been in the news this week. They haven't officially made an announcement, but there's some rumors from credible sources. They have over 325 million users. Just overall thoughts on this rumor. How do you think PayPal being crypto enabled is going to impact cryptocurrencies and stablecoins?
So, I mean, I think it's really exciting. Obviously, that it's not confirmed, but I think it's really exciting. It's interesting when you think about, when the crypto industry really got started, there was a lot of like, hey, we're going to build something where you don't actually even need PayPal. Like PayPal was sort of the first generation of kind of how this worked. And
PayPal without PayPal.
Sorry?
It's the PayPal without PayPal.
Right. And I think our view is a little bit more nuanced, which is that there are digital wallets. It's really digital wallets are at the forefront of the future of consumer finance. So products like Square Cash, products like Venmo, products like Revolut, and then all around the world, Tencent, Alipay. These are the forefront of retail finance. It's not banks. And so all of those platforms are going to support cryptocurrency. All of those platforms are going to support stablecoins and are going to provide interoperability. And just like I can send an email if I use Gmail and you use Yahoo and someone else uses Baidu in China, we can all communicate with each other. We have interoperability because of standards. I think that you will see the leading digital wallets adopting standard protocols for doing, say, dollar-based transaction settlement on the internet. And I think that that's going to happen. Obviously, Libra Association's driving some initiatives there. What Center Consortiums do is driving some initiatives there. And I think you'll see more of that. And having major players like PayPal, getting into this industry is really great news, and certainly demonstrates that in the next year, we're going to see much broader mainstream adoption and use of cryptocurrencies.
Right. Yeah. I mean, it's an on-ramp for retail, just make it more easy and more accessible to on-ramp into the crypto ecosystem. We got a question on a regulatory topic. Circle was the first company to receive a BIT license from the New York Department of Financial Services. And the question is kind of around how DFS requires stablecoin issuers to either freeze, forfeit, or seize stablecoins themselves, in addition to the currency that's backing them. General thoughts on those requirements, and if it's incompatible to the practices to traditional banks, and is the standard being held to crypto products and crypto companies higher than traditional banks and financial institutions?
Yeah, it's a really good question, and it raises a lot of issues. And so Center Consortium, for example, defines, and the technical specifications of USDC do include a blacklisting feature, which is specifically used in a scenario where a U.S. court of competent jurisdiction with an appropriate court order could freeze assets that exist. So that is something that is a regulatory requirement, and that does exist. That capability does exist. I think this is a new world. There's not a lot of track record on how this is going to be used in the world. It is similar to asset seizures that might take place with a financial institution. So there are some similarities there, but I think that is very much what is in the regulatory mandate today, and the way in which government and law enforcement interact with digital cash is obviously a new space, and there's going to be a lot of learning and figuring it out. Absolutely.
Well, Jeremy, thank you so much for joining us today. Really appreciate your insights. Love the thoughts on internet maximalist. I agree. Everything is going digital, and we need to upgrade infrastructure and think about value transfer in how we do business and operations online and on the internet. Always a pleasure. Thanks, Jeremy.
Thanks, Perry Ann. Thanks so much.
All right, our next speaker is Raphael Kozman. He's the co-founder of Trust Token and the maker of True USD. True USD is a stablecoin that is fully collateralized by the US dollar. It's redeemable 1-for-1 for the dollar and is trading on over 70 exchanges today. Raphael leads engineering and product for Trust Token. He studied computer science at Stanford. He worked at Google Brain before he started Trust Token. And when he is not working, you can find him swimming or reading. Raph is a native Floridian. I will always join you on the swimming excursions. We appreciate your time in joining us today.
Thanks, Perry Ann. Appreciate the introduction. Good to be here. Can you hear me all right?
We can hear you. Yep.
Cool.
Yeah, loud and clear. So, Raphael, I thought it would be really interesting to talk with you about stablecoins, but also about DeFi, because I think there's this really interesting movement in the space, and also this sort of unique intersection between the two concepts generally, but the two mechanisms. So maybe we could start there, and you could give us the DeFi 101. What the heck does DeFi mean?
Sure. So DeFi is short for decentralized finance, and it includes things like Compound, DYDX, Aave, Curve.fi, Uniswap, some of these products that folks here may have heard of or may have used personally. And as Jeremy explained, these are systems for financial transactions without intermediaries. So an example is Compound. People are doing borrowing and lending directly with a smart contract. So that's a piece of code that's running on the blockchain. There's no intermediaries that are holding those funds before they can get lent out. Putting them directly into the smart contract, and the smart contract is directly lending them out. So part of the reason why it's exciting is because it allows for less trust in the intermediaries. You can just look at the code and you can assess directly it does what it's supposed to do, and can hopefully lower the transaction costs a lot by being able to cut out some of those intermediary parties.
So, as I said, there's been a lot of movement in this space. What are some of the headlines just in recent weeks for DeFi or recent months regarding DeFi that stick out to you?
Well, there's been a handful of major hacks that have happened, and sometimes losing pretty significant amounts of money. And some of the DeFi platforms that I've named, like Compound, DYDX, and so on, have done pretty well and stayed clear of these attacks. But there are a couple of others, like Fulcrum, that have been hit pretty hard. And once a platform like that gets hacked once, it severely degrades users' trust in that particular platform, but also can degrade users' trust in DeFi in general. I mean, I think one of the benefits of DeFi is that developers everywhere can, create a smart contract, launch it, and people can start using it with real money. But the problem with that, the disadvantage is that it is much more of a buyer beware situation. And many of these smart contracts and these companies producing them are not regulated, or at least are not choosing to submit to any existing regulatory regime. And so they could be, playing a lot faster and looser with people's money than a conventional institution that ultimately when people are going to get sued or go to jail if they do lose people's money.
Yeah, there's a couple interesting things there, because I think one countervailing point is around the sort of perspective of the user, the willingness to get involved or put stake into something like this, which is essentially an experiment still. I think you would agree in many ways.
Very much so.
But even just in the last 4 months, I think DeFi market caps across these protocols and these sort of options that you'd mentioned, something like 500 million, bouncing around in market cap. And over the past 4 months, we've tripled. I think today it's something like 1.6 billion is locked up in these contracts. So on the one hand, I mean, yes, it's absolute peanuts compared to 11 trillion in U.S. customer dollar deposits at financial institutions, but it is a significant, I think it indicates a significant willingness for individuals to make that sort of gamble that you're talking about, or take that risk to experiment with these protocols. So why do you think people are interested in these protocols? Why are people taking that risk?
Yeah, part of the reason they're taking the risk is because the rates in DeFi right now are quite good. And the interest rates in crypto in general are really good. So just to give some examples, right now on Compound, if you go to compound.finance, on Tether, you can earn 4.5% APR if you deposit Tether. Depending on other cryptocurrencies, sometimes it's 5% or 6%. And that's a pretty great rate compared to the rate on the US dollar, which right now is extremely, extremely low. So we have been seeing both some of the issues with DeFi and hacks that are happening, but also, as you point out, tremendous amounts of growth. And that's partly because DeFi there are some ways in which it's fundamentally more efficient. We just, with very, very low cost, money is able to flow around the globe to wherever it's needed and whoever is willing to pay the most to borrow it. So capital is just flowing from places with low cost of capital to places with high cost of capital much more easily. And that's part of what's creating the high rates on DeFi and on crypto in general, the high interest rates that are available.
One other thing I think about with DeFi is it really decentralized? I mean, it is insofar as the protocol can operate in a distributed way, right, on a blockchain. As Jeremy mentioned, right, on this sort of 2.0 or 3.0 version, where you have a virtual machine essentially that runs across the blockchain. But then again, they are a company, right, where they are a group of individuals who come together to build the protocol and maintain it. So what do you think about that? I mean, is it really decentralized? I guess I asked you that because you said they're sort of maybe unregulated, or there's some open questions for regulation of DeFi. And I thought, well, are they really decentralized? So what are your thoughts on that?
Yeah, I'd say to varying extents. So, you know, like Bitcoin is potentially one of the most deregulated and one of the most decentralized blockchains. You know, Ethereum still has Vitalik and the Ethereum Foundation, which exert a certain amount of control, and that does allow Ethereum to change more quickly than it could otherwise. But it also, could create risk if you disagree with what some of those more centralized actors are doing. So similarly with DeFi, you can have smart contracts out there where there's literally no one who has control of it and who could upgrade it or change it. And that is a benefit, but it also could be a downside because that means that, that it'll never receive security patches or updates or improvements in the system. So it's very much on a case-by-case basis how decentralized these things are. We're right now, we just recently launched a product called True Rewards that's in a closed beta right now. That's meant to make it easy for users to get access to DeFi, things like AV, Compound, DYDX, and so on, and easily be able to just look at the different options and select between them. And there is right now a lot of variety, and users do have to really think about which one they want to trust. And there is oftentimes millions and millions of dollars on the line. So I think Compound today has about $870 million and $870 million. That's a pretty significant amount of money. And it's because users have looked at this smart contract and they trust it. And other platforms have less. Some platforms have more. It's very much based on just what are users choosing to trust with their funds.
Do you see stablecoins as sort of a necessary ingredient in the recipe of DeFi? Or is it bake your own cake? I mean, I see that there's an intersection, but are they necessary in that ecosystem?
Yeah, I think that they're very necessary. And I think actually part of the reason why the DeFi is exploding right now in usage is because of stablecoins. They're really going hand in hand because earning, a lot of DeFi, what's interesting about it is that, so there is a wave of crypto, it's 2017 and before that, which was a lot of folks coming in to buy equity-like products, things that could go up 100x. You buy some token, whether that's Bitcoin or whether that's a quote unquote shitcoin, and it could go up 10x or 100x. It could crash to nothing. And those are the types of products that people are buying. And at least for some period of time, that portfolio of products seemed very attractive, and some people still think it's today very attractive. But it was certainly extremely high risk. And we're now seeing a shift towards debt-like products, interest-bearing assets, where it's not going to 10x or 100x, but you could earn a steady 3%, 4%, 5%, sometimes even 8% or 10% per year. And that's very attractive compared to what's available on most fiat currencies today. So that shift is starting to attract into crypto folks that are looking for, that are not quite so speculative, are looking for more steady returns, and they're willing to take some risk. I mean, these certainly aren't FDIC insured bank accounts. They are higher risk, but they aren't the level of risk of when you just buy a cryptocurrency that could go up or down by 10x. So that's part of what this market is appealing to, and we're seeing a lot of money flood in. And it's not that interesting. It's not nearly as interesting to earn a high interest rate on an already extremely volatile cryptocurrency. I mean, there is a market for that, but you're already, the vast majority of your upside or downside is determined by the cryptocurrency, like if that's Ethereum or Bitcoin or something else. So getting 5% on your Ethereum, well, you're probably Ethereum could 5x or go down by 5x while you're earning that 5%. But earning an attractive interest rate on a stable coin, that's really interesting. And if it's secure enough, that could be a huge product with not just hundreds of millions of dollars, but in the future hundreds of billions or even trillions of dollars.
One thought that comes to mind is to say to the audience that I know we have a varied audience. We have very technical users. We have co-founders of companies and CEOs, and we've got on the other side, attorneys and those with a regulatory mindset. I would say for the sort of the latter and the middle group that it's super important to try this stuff, to just put your hands on it and see how it feels. Because it's one thing to theoretically say, wow, look at this sort of risk reward calculations going on. Aren't there consumer protection issues? If we're talking about personal finance and putting into this smart contract and this hard to understand new experiment, but you should try it because you will learn for yourself. You'll see these things in real life. So I did that. I spent last weekend playing a lot with DeFi, put a nominal amount of money in, and just moving things here and there, seeing how I can expose a wallet, to these given platforms. And it's pretty compelling stuff, honestly. I think it's very, very early, but pretty compelling. So into a question real quick. One of the things you mentioned was these vulnerabilities. And I think that first off, we can say that current financial system has vulnerabilities, current financial technology has vulnerabilities. So it's not unique to DeFi exactly, but some of the ways that it is vulnerable are kind of unique. Can you tell us a little bit about what are the big buckets of vulnerabilities right now for these types of protocols?
Yeah, so in terms of just recent attacks that have happened and vulnerabilities that are most common, there's just technical bugs. One of the issues is that what's actually running on blockchains like Ethereum is EVM bytecode, Ethereum virtual machine bytecode. It's a low-level language similar to how assembly is running on your computer. And while programmers are writing high-level programming language like Solidity or Viper, it's ultimately compiling down to bytecode. And whether your program is secure or not depends on that bytecode. And so, unless you very rigorously, are testing your code and are doing potentially even a formal verification where you're mathematically proving certain properties of your compiled code, it's very difficult to know, even if you work with professional auditing firms, if you're truly pushing something that is secure. And when you're doing normal development of like back-end code, if you're just building a web server or something else, if we're not working on the blockchain, then you can actually get away with a lot more, because if you have a bug or you have 10 bugs, there's still a good chance that they won't be found, because there aren't people that are looking over your code in tremendous detail trying to find those bugs, by and large. But when you're writing code for the blockchain, you've got both a huge number of people and also machines that are scanning every single piece of your compiled code looking for any vulnerability. And there's oftentimes tens or hundreds of millions of dollars on the line, so they're very incentivized to find any issues. And so your probability of actually having an attack, if you do ship a bug, is much closer to 100%. And then there's, in addition to those technical issues, there's also just the financial issues of people using price manipulation to create attacks. So there's a recent attack on a product called Fulcrum, where part of the attack, it was a fairly sophisticated attack, and part of it was doing price manipulation of a decentralized exchange. So when you have smart contracts that are doing borrowing and lending, things like Compound, DYDX, and so on, oftentimes they need to know the prices of various assets, whether that's a stable coin like TrueUSD, or it's Ether, or it's something else. And they need to get that from some data source. And that's oftentimes an on-chain decentralized exchange where people can actually transact TrueUSD versus Ether, or USDC versus Ether. But the issue is that someone can, in the course of a single transaction, they could sell $5 million of Ether onto that exchange, significantly bringing down the price, especially because a lot of these decentralized exchanges have lower liquidity than centralized exchanges like Binance, OKX, and so on. So you could do a large sale or a large purchase, significantly changing the price, then go and take out a loan or make a loan, interact with a decentralized market that's doing lending, and that market might be, if they're pulling the price feed from that decentralized exchange, it might be confused and think that the price is something other than what it really is, when you have just temporarily manipulated it in order to take a certain action, whether it's paying back a loan or taking out a loan, and then eventually the price will correct. But at that point, it could be too late, because the decentralized exchange might have already made you a big loan, thinking that your collateral was worth a lot more than it actually is. So these are the types of attacks that we're seeing, both technical and sort of financial attacks. and the best practices are still very much emerging. So it's not clear, even for some of the most trusted products on the market, how safe they are.
Yeah, Raphael, you mentioned a lot of the challenges to DeFi, and one of the ones that we see is just the mass adoption. How do we reduce the complexity of these projects for the average user, while me, you, and many of our members certainly can navigate through these challenges and use the technology. The average person, that learning curve is quite complex. And in order to make this ready for mainstream, how do we address the complexities in the DeFi space?
Yeah, that's definitely one of the biggest issues that we're seeing. And so we're working on a product to address that. And the goal with this product that we're just recently released, it's in closed beta, should be in open beta soon. But the idea is basically to allow you to access DeFi from directly within a stable coin. So you could be holding, let's say, 100 True USD in your wallet, and then say, okay, I want to use AV, or I want to use Compound or DYDX or another one of these platforms. You just flip a switch, and then your stablecoin balance in your wallet will just start increasing as you get rewards from that DeFi platform. And then you can say, okay, well, I'm done. I want to opt out of this. And then you'll just have normal True USD again, not earning any rewards over time, and just totally safe. And so just making it really easy and seamless to opt in and out, and not having to go learn about 5 different platforms, but be able to just say, okay, I want to opt into this one, and you immediately start getting rewards coming into your wallet. That solves some of the usability issue that you're asking about, but there's still a risk issue, which is that users have to actually be able to assess these platforms. And so we're working on something for that, which is called trust token assurance, which is basically a risk market for DeFi but then in the future CeFi financial opportunities. So basically having experts that are able to go and assess these platforms and provide what's sort of like insurance for the platforms themselves, saying, hey, I'm willing to put up, let's say, $1 million, saying, I think AV is one of the partners that we work with. They're a major decentralized market for borrowing and lending. Someone can put $1 million and say, I think that AV is very trustworthy. I've looked at the code. I've looked at how they get their price feeds for their prices of the assets they trade, and I think everything's very solid. And I'm willing to put $1 million, and I'll take the first loss if they end up having any issues. So I'm going to take the loss before any of the normal depositors. This is sort of experts or companies that are in the business of providing this kind of assessment that can provide that assurance to end users, and then end users won't have to do a kind of deep technical assessment that's really infeasible for the vast majority of DeFi users, but they'll be able to have that source of information knowing that something is already assured.
Great. Well, certainly share your enthusiasm. I think there's so much promise within DeFi and the future of stablecoins and the future of monetary policy and the global financial system. And going back to Jeremy's ideas of being an internet maximalist on how we transfer value instantaneously around the world. I appreciate you sharing your thoughts and insights, and also how Trust Token is appreciating this. No, appreciate your time. All right, Raphael, appreciate your time.
Thank you.
We'll introduce our next speaker.
Thanks a lot.
Thanks, Fran.
Thanks.
All right, and our fourth but most anticipated speaker, Walter Hessert. He's the head of corporate strategy at Paxos. Paxos operates Paxos Standard, or PAX. That's a digital dollar that can move anywhere in the world, any time of day. It's programmable. It's backed 1-to-1 for the dollar, and was issued by Pax Trust Company, or the Paxos Trust Company. So that provides an audited, regulated structure for their digital asset. Paxos shares a vision of a frictionless global economy where all assets can move around the world instantaneously, 24 hours a day, 7 days a week. Walter, thanks for joining us to share your thoughts on this.
Thanks a lot, Perry Ann. Thanks for having us on.
Thanks for being here, Walter. When I was preparing for this, which is a little bit like writing a book report while the author is still writing, by the way, a little bit difficult because there's so much going on. I realized that PAX actually got its start a lot, or Paxos as a company got to start a lot earlier than I realized. I don't know if people know that, but I think you guys really started this project in about 2012. Is that right?
That's correct.
Yeah. And I think one of the interesting things that you're a strategy guy, so I kind of wanted to think about the future of stablecoins and from a strategy perspective, sort of operating models, and get your insights sort of in that perspective. So one of the things that Pax does is, I guess you could say, you've sort of vertically integrated. Can you explain how Pax as a token and Paxos as a company, and then Paxos as a trust company, and how that all works together?
Yeah, absolutely. I think it's helpful to step back to your point. There's quite some history to Paxos as a company. We launched IPID in 2012. We were the first regulated exchange to launch in the U.S. in 2015, and we got our trust charter in 2015 as well. And obviously many developments since then. And just the purpose of Paxos, or our mission at Paxos, is to create a more open and accessible financial system. And we're doing that by building and creating highly regulated financial market infrastructure. And that's why we set ourselves up as a trust company. Really, this predates me by some years, but that was really the vision of Chad, our founder, that as a trust company, we could have the highest level of oversight to hold people's assets. And in holding our clients' assets, and by the way, that's all types of assets, so not just crypto, but also cash, which is the asset underlying our stablecoin, and commodities and securities. We're then able to enable them into blockchain environment. And in that way, we're able to serve as this gateway between traditional and digital assets. And so that's what we've been building, and we're really excited about that mission, and we're really excited about all the progress we've made to date, and probably most excited about all of the movement that's happening now. When we think about Pax was launched at the end of 2018, and it was our first stablecoin. It was the first asset we issued. It was the first regulated and the regulatory approved issued asset in the U.S. and maybe in the world. And it served as an important step, I think, in the evolution of what we've seen in the stablecoin industry, where you had Tether start to proliferate and really start to grow, and has continued to do so today. And then you saw the introduction of some stablecoins that moved the conversation along to build a stablecoin that was more transparent and potentially maybe even more usable outside of what was the main use case that Jeremy spoke about earlier from the early days, which was crypto trading. And they did that through like really kind of innovative products, certainly like attestation, some of the stuff that you guys have built at Armanino. And we then took it to the next level by going out and getting the highest level of regulatory oversight and actually approval from our regulators and oversight in the issuance, so that they actually oversee the issuance. And we still think that's certainly we're happy that we approached it that way, as the conversations for CBDCs start to pick up, and maybe more importantly and more near term, some of these really large non-crypto companies start to look at stablecoin and start to figure out the types of stablecoin products that they want to launch to their customers. In 2019, we launched 2 other Paxos-powered stablecoins as part of our stablecoin as a service. Some call them white label stablecoins, which they look like in some ways. And these were stablecoins with partners. We launched BUSD in partnership with Binance, the Binance Dollar, and HUSD. And so this was stablecoins that was able to, Binance, for example, was able to leverage the Paxos infrastructure, our regulatory stack, and our tech stack to quickly launch an asset that has the highest level of regulatory oversight with the Binance brand name on it. And so that's been a really key piece of the Paxos stablecoin story and our growth in the stablecoin area, and will continue to be as we're in the middle of kind of advanced discussions, and in some case even integrations with partners, with platform partners for some of the same offerings.
It seems like, I think it's fair to say the most traction in terms of market cap and actual trade volume is in these fiat collateralized models, right? So like a Pax token, like the others we've talked to today, and Tether, of course, being the largest market cap. coin. Although I think it's still, most agree is an outlier in some ways when we have this conversation about regulated stablecoins. Is that the model for the future? I kind of asked Jeremy this question, but I want to ask it in a slightly different way. Is this centralized fiat-backed one-to-one model the model for the future, or does that evolve? Does it evolve into something that maybe is not one-to-one backed, like our sort of retail dollar is today? Is it something that's more algorithmic? Is it something that's basketed? What do you think about that evolution for the future?
Well, where it ultimately evolves to is a little bit above my pay grade. I would say that, for the near-term future and the big developments and the new entrants and the new solutions that we're going to see come about with stablecoin, I'm fairly confident to say that they're going to be one-to-one backed with fiat currency. And when we get to CBDC and they're backed by Treasury bills, that your Treasury notes, that's that will be a next stage. But I think that being back one-to-one by fiat is likely to be the near-term future for stablecoin. And it's just because the others, a multi-asset backed token, is a little bit too big of a puzzle to solve right now, I think. And we saw that with Libra, particularly on the regulatory front. All the backlash that everyone was kind of tuned into here, I'm sure. And so I think that, even from Libra, news has come out that they've kind of changed their vision and the launch plan to maybe a handful of single one-to-one fiat-backed tokens that might be traded into a kind of like a basket token. But I think that that's a pretty good indication that model is here to stay for a while.
If I can actually add my monetary policy thoughts on this, it's really a fascinating discussion to have. With Libra came out with proposing that this basket of currencies, but a lot of that pushback came from U.S. regulators, and it looks like they may be doing a one-to-one to the dollar to kind of appease concerns from the U.S. perspective. But there's certainly other groups that could be completely outside of the United States that go with a different approach. The IMF's, their currency, the special drawing rights, that's a basket of currencies. And Mark Carney last year at Jackson Hole also proposed an alternative to the dollar. That's a basket of currencies. And then it also kind of sounded like that's what Jeremy was alluding to as well when he started talking about synthetic currencies, that it wouldn't necessarily be one-to-one to the dollar. You would have like a global reserve of different assets, whether that's a mix of different countries' fiat currencies and or commodities like gold that could be mixed in there. There's no right or wrong answer, but there is like a very proliferation of stable coins and crypto assets that are coming into the markets. And you have, in addition to that, you have these international groups like the Bank for International Settlements, the IMF, the World Bank. These groups all provide global banking services. So they could issue all sorts of different type of crypto assets and tokenized products. Then you have the central banks, from the Fed to the People's Bank of China to whom else, and then you have commercial banks. JP Morgan Coin is one that's been already announced, and there's other commercial banks that likely will have tokenized versions of their balance sheets. And then we start getting into these private stable coins and decentralized stable coins. So I think there's like a huge world of crypto assets that we're seeing, but it's really, we're in the middle of this massive evolution of the monetary system. And I think we're in the middle of a big change to how financial services are going to look and what money is. And it's probably one of the most important conversations we can ask ourselves today is what is money? Because it's literally changing right in front of us right now.
I certainly, Perry, those are great points. I think that global synthetic currencies seem very possible. I think that the network of currencies, the fiat currency, is just so strong. The dollar network is, we know the power of networks, and it's one of the most powerful networks. And so it seems logical, and this is why I think everyone in the industry should be really grateful for groups like the Digital Dollar project that are really pushing this conversation forward on the regulatory side and with the policymakers is that it's an opportunity here for the U.S. and I think that it's I'm hopeful that we'll see a global U.S. dollar stablecoin, and I think it's very likely.
Interesting recent publication that goes to sort of both of your points is a recent Fed paper. I think it was just released on the 20th or something. So I haven't gotten to read the whole thing, and it's full of math equations, so my eyes go cross. But essentially, they assess this Mark Carney idea. They assess the Libra basket idea. And I think the conclusion in the abstract is pretty interesting. They basically say, they're creating a model for trade shocks and whether this kind of basketed currency makes sense from a global perspective to reduce the impact of those trade shocks on local governments and holders of currency, people, essentially. And it's like that the overall demand is actually going to be small. While there could be actually really significant welfare increases, that the demand will actually not be very large. And so I think that kind of goes to your point, Walter, that that maybe this centralized fiat-backed model does win out for a while. Seems to be some smart people who agree with you. So invite everybody to read it, or at least the abstract. So one other quick question for you. We're going to run up on time, but I was curious. So one other thing that you're working on is a settlement service, and there's some big players involved there, Credit Suisse and subsidiary of Nomura Bank, I think Société Générale, the French bank. So do stablecoins play there, or is this really just an equities settlement service on blockchain, or do stablecoins play a role here for dividends or purchases or redemptions or anything like that?
Well, we certainly think that stablecoins, all of the products that we're tokenizing, that we are, custodying and tokenizing, have synergistic aspects to them. And long term, will stablecoins play a part in tokenizing and settling tokenized securities? Absolutely. Today, as you mentioned, we have these really exciting large financial institutions participating in our pilot as we apply for our own, full clearing agency registration. And I think that when we look across what we're doing in security settlement, what we're doing in gold, what we're doing in dollars, they all are in line with the mission of Paxos, which is to create a more open financial system and allow these assets to facilitate the movements of these assets at the speed of the internet. Obviously, today, dollars are really critical to allowing that to happen. They're about one side of about 80% of transactions and trades in the world. And so all of the assets that we're tokenizing to facilitate the movement of them, we see regulated stablecoins as a key component.
Awesome. Thank you for your insight, Walter. I appreciate you batting cleanup and hitting homer for us. It's been great, all of our guests. I really wish we got to more audience questions. And so as a quick wrap up, let me say that I'll write a little something for the audience after, and we can distribute it in partnership with the Chamber. Just a quick recap, and maybe to try and get to or demystify some of the questions that were asked here that we didn't get to. So yeah, thank you to everybody. Thank you for joining. And with that, I'll let Perry Ann put a bow on this. What do you think, Perry Ann? Do we have a couple of minutes for questions?
I think we're at the top of the hour here, but we've received a few questions in the Q&A that we weren't able to get to. So we're going to write those up, and we'll collaborate with the speakers to get the responses in writing. Maybe we'll do a blog to get those out or reach out to you guys individually. Want to thank all of our speakers, Walter, Raphael, Jeremy, Daniel, for joining us. Also want to thank Noah and Armanino for co-hosting today's webinar. If you're listening to this talk and you want to take a deeper dive with us, we want to invite everyone to participate in a couple conversations that we're having at the Chamber on these topics. We currently have 2 opportunities to advance the conversation around stablecoins and digital payments. One, we're in the process of reviewing the Digital Dollar Project's white paper. Dan spoke about it at the top of the webinar. we're holding a series of meetings with our members. We're going over it together as a membership in detail. Some of the things we've raised are the role of a digital dollar within the two-tiered banking system within the United States. We're looking at the benefits and challenges of open versus closed systems, financial inclusion, and privacy considerations. So if you want to participate in those conversations, let us know. And we're also preparing comments to the Financial Stability Board. Jeremy mentioned this when he was talking, but we are writing comments to address the regulatory, supervisory, and the oversight challenges raised by global stablecoin arrangements. So if either of those conversations are ones you'd like to participate with us, please reach out to Patrick South, who leads our member services and development efforts. His email is here on the screen, patrick@digitalchamber.org. And lastly, we also want to invite you to join us for Parallel. That's our virtual event series. The next episode is scheduled for July 17th at 1:00 p.m. Eastern. We'll be joined by the director of the Financial Crimes Enforcement Network, Ken Blanco, and Brad Garlinghouse, the CEO of Ripple, will be joining us as well. See you guys in July at Parallel. Thanks so much.
Thanks, Marianne. Thanks, Noah.